Hey everyone, Bryan Miller here, your trusted local mortgage lender coming to you from my office right here in Tupelo, Mississippi. In today's market, there's one topic on every potential home buyer's mind: interest rates. You see the headlines, you hear the speculation, and it's easy to feel like the rate you get is something that just happens to you, something completely outside of your control. But I'm here to tell you that is absolutely not the case. While we can't control the global economy, you have a significant amount of power to influence the interest rate you are offered. Getting the best possible mortgage rate isn't about luck, it's about strategy. It's about taking deliberate, practical steps to make yourself the strongest possible borrower in the eyes of a lender. Today, we are going to walk through the ultimate playbook on how to get the best mortgage rate in today's market.
The first and most powerful step in your strategy is to elevate your credit score to an elite level. Your credit score is the single most important factor that lenders use to determine your interest rate. We operate on a system of risk-based pricing, which means a higher score signals lower risk, and lower risk is rewarded with a lower interest rate. While a score of 620 might be the minimum to qualify for certain loans, our goal isn't just to get you qualified, it's to get you a deal. The best rates are reserved for borrowers in the top credit tiers, typically those with scores of 740, 760 or higher. The difference in the rate offered to a borrower with a 680 score versus a 760 score can be substantial, saving you tens of thousands of dollars over the life of your loan.
So, how do you get there? Focus on the most impactful actions. First, attack your credit card balances. The second biggest factor in your score is your credit utilization ratio. By paying down your balances to below 10% of your available credit limits, you can often see a very quick and significant boost in your score. Second, scrutinize your credit report for errors. Finding and correcting just one mistake, a late payment that wasn't late, an account that isn't yours, can sometimes be worth a quarter point on your interest rate. Finally, we can be strategic with tools like a rapid rescore. If your score is just a few points away from the next tier, we can create a plan. You might pay off a specific card, and once we have proof, I can submit that documentation for a rapid rescore, which can update your credit score in just a few days instead of a month or more. This is a powerful tool we can use right before locking your rate to ensure you get the best possible terms. The second tip is to optimize your down payment. Now, we've debunked the myth that you need 20% down to buy a home, but it's important to understand how the size of your down payment influences your rate. Lenders look at your loan-to-value ratio, or LTV. If you put 5% down, your LTV is 95%. If you put 20% down, your LTV is 80%. A lower LTV represents less risk for the lender, and less risk can translate to a better interest rate. The pricing adjustments are often tiered. For example, the rate and mortgage insurance costs might be better for a borrower putting 10% down versus someone putting only 5% down. This doesn't mean you should drain every penny of your savings for a down payment. In fact, sometimes taking a slightly higher interest rate in order to keep more cash in your emergency fund is the smarter overall financial decision. It's a balancing act, and it's a conversation we can have to weigh the pros and cons for your specific situation. Our third tip is to lower your debt-to-income (DTI) ratio as much as possible before you apply. Your DTI is a measure of your monthly debt obligations compared to your monthly gross income. While a loan program might allow for a DTI as high as 43% or even 50% in some cases, a lower DTI makes you a much stronger borrower. In the eyes of an underwriter, a low DTI is a significant compensating factor. It shows that you have plenty of cash flow and can easily manage your payments. This financial strength can sometimes help you secure a better interest rate, even if your credit score isn't in the absolute top tier. There are two ways to lower your DTI: increase your income, which is often difficult to do quickly, or decrease your monthly debt payments. The fastest way to do this is to strategically pay off smaller loans completely, like a small personal loan or a credit card with a low balance. By eliminating that monthly payment entirely from your calculation, you can improve your DTI and the overall health of your loan file. The fourth step in our strategy is to choose the right loan product for your personal financial goals. The 30-year fixed-rate mortgage is the most popular, but it's not your only option. For some borrowers, an adjustable rate mortgage, or ARM, can be a very smart choice. An ARM offers a lower introductory interest rate for a fixed period, often 5, 7, or 10 years, before it begins to adjust based on the market. If you know that you are likely to move from Tupelo for a job transfer in the next 5 to 7 years, why pay the higher interest rate of a 30-year fixed loan? An ARM could save you a significant amount of money and interest during the time you know you'll be in the home. Similarly, if you have strong cash flow, a 15-year fixed-rate mortgage offers a substantially lower interest rate than a 30-year loan. Your monthly payment will be higher, but you will pay off the house in half the time and save a fortune in total interest. Choosing the right product is a key part of the rate-setting strategy. Next, our fifth tip is to understand the art and science of locking your interest rate. A rate lock is a guarantee from me, your lender, to hold a specific interest rate for you for a set period of time, typically 30, 45, or 60 days while your loan is processed. You cannot lock in a rate until you are under contract on a specific property. This creates a strategic dilemma. Once you're under contract, do you lock your rate immediately, or do you float the rate for a few days, hoping the market might dip and rates will improve? My professional advice, especially in a volatile market, is that if you are comfortable with the monthly payment at today's rate, you should lock it in. Trying to time the market perfectly is a gamble that can backfire spectacularly. A good lender will watch the market trends with you and have an honest conversation about the risks and rewards of floating versus locking, helping you make an informed decision you feel good about. Our sixth tip is to consider paying for discount points. A point is an upfront fee you pay at closing, equal to 1% of your loan amount, in exchange for a permanent reduction in your interest rate. For example, on a $250,000 loan, 1 point would cost you $2,500. This might lower your interest rate by roughly 0.25%. Whether this is a good idea depends entirely on your break-even point. Let's do the math. If paying that $2,500 saves you $50 on your monthly payment, your break-even point is 50 months or just over 4 years. If you are confident you will be in the home for longer than 4 years, then paying that point is a smart long-term investment that will save you money every month for the rest of your loan. If you think you might move in 3 years, it's not a good deal. We can run this calculation for you to see if it makes sense. Finally, the seventh and most crucial tip is to partner with a great local lender. As a mortgage professional here in Tupelo, I don't just work for one bank. I have access to numerous wholesale lenders and a wide variety of loan programs. This allows me to shop for the best possible fit for your specific financial profile. I understand our local market, from property tax nuances in Lee County to the specific requirements for different property types in our area. A great lender isn't just a rate quoter, they are a mortgage strategist. We are the ones who can guide you through all the steps we've discussed today, from credit optimization to choosing the right loan product and timing your rate lock. Getting a great mortgage rate is not a passive activity. It is the result of a proactive, strategic effort to strengthen your finances and make smart, informed decisions. It's about taking control of the variables you can influence to achieve the best possible outcome. If you are ready to build your own personalized best rate strategy and want a dedicated partner to guide you through the process, my team and I are here to help. Be sure to like this video, subscribe to my channel for more expert mortgage strategies, and leave any questions you have in the comments below. Thanks for watching, and I look forward to helping you save money on your new home.